So the first time I interviewed you was in 2024 at the IMO Summit. And the very first question was, why did your process fail? I was surprised at how candid you were and how much you actually enjoyed talking to me after the fact that I asked you such a hard question. Now it's 2026.
Yep.
Clarion was supposed to sell. It hasn't sold. There was a rumor that you guys might have been on the market again last year. That deal didn't happen. What is going on in the M&A markets right now for both like Questex, but more holistically in our market? Like, what's going on right now?
Yeah. Firstly, we were not on market last year, so I should clarify that.
Clarify away.
We were not on market. That doesn't mean that people were not pinging us with interest, which is probably where that comes from. What's going on? I think you've got a whole confluence of different factors that are affecting the M&A market. So you've got the interest rate situation, which although it's lower historically than some of us have lived with in our lives, it's still high, relatively speaking, versus recent years, i.e. money is not at free levels, zero levels of interest. So that has put more pressure on penciling out what acquisitions make sense, where the return on investment is, can we get the right rate of return for the investors? And that means that anything that might be a risk or perceived risk or questionable actually gets elevated, and probably gets elevated, in my opinion, to a level where it becomes such a huge issue that people then get a little scared to go forward with M&A. If you've got a really great asset that often can be a single asset, a single event, a single product, then obviously the risk gets somewhat reduced as long as it's a strong product. There aren't many flaws with that. And therefore you can see those do get transacted, and some of those did happen. But many businesses have a whole portfolio of product in many markets. Some markets are strong, some markets have some headwinds, hence that risk, hence that gets elevated. And so I think people just get a little scared at the moment in terms of, can it pencil out with return on investment? I would add there's kind of macroeconomic situations, there's stuff going on around the world which adds to the risk. There's AI, and where is that going, which adds to the risk. So you just get to a whole confluence of issues that get in the way of getting things done. Not to say that acquisitions aren't getting done. We made 3 in the back half of last year, so they can get done. They're just harder.
Yeah, we'll talk about those deals. But as we look to 2026, are we starting to get a little bit of clarity now? Like every year, it feels like we ask the same question: is this the year where the big deals happen? Are we starting to get there? Are you starting to see that from the conversations you're having with operators and investors?
Yeah, I smiled when you asked the question, because this time last year, almost exactly to the day, I said, yeah, this is the year. And I was completely and utterly wrong for reasons that I couldn't foresee. I think the short answer to the question is you've got a couple of pressures that are starting to happen. Firstly, we're getting into longer holds for private equity, so 7, 8, 9, 10 years and above. Which puts a bit of pressure on the PE firms to transact and return some equity to the investors. I think secondly, you have a lot of dry powder that's sitting there. So you've got that almost the other end of of the telescope, if you will, is that there's people with money to spend that they want to put to work. I do think that where your question's going is are we going to be able to cope with the uncertainty, and are we going to have to get comfortable with the uncertainty that's out there? And I think the answer is yes. I think we're starting to see business still needs to happen. This is not a, quote, COVID scenario that we're living in. We're not shut down. Right. It's hard. There are some headwinds, but business has to happen. And therefore, I think people are going to sort of start to, on my risk point, they're going to start to see that risk dissipate a little bit, give the other 2 pressures, long holds, dry powder. I think you're going to see transactions start to happen. But I did say that this time last year, and I was wrong.
Who, remove Questex from the equation, because you obviously won't tell me that's that answer, but who do you think is the first big player to transact if it happens this year?
Yeah, that's a great question. And I'm not privy to all of the who's even thinking.
But there are always rumors.
The strong rumor in the market is Closer Still, and I think they're an excellent business. So if the rumor's true, and knowing what I do know about that business, I would say that is probably likely to be one that could go. Again, I honestly don't know, but if you wanted to really wrestle me to the ground, that's the rumor. I think they're exploring, and they're a great asset. So yeah, that could be the one to go first.
All right. So now that we've got our market report taken care of, let's imagine that I've got a massive pile of cash and I am looking to buy Questex.
Yes.
What is the elevator pitch? Tell me, what is Questex?
Yeah, simply put, we are a connections business in the B2B marketplace. We work in 4 verticals: life sciences, healthcare, wellness, and those two are starting to sort of cross into each other a little bit in a good way. We are in the tech area. We're in the hospitality area. So life sciences, healthcare, wellness, tech, and hospitality. We have a very sort of, I would sort of call it progressive approach, in that we do believe that events are a great place to gather decision makers, but media is a great place to continue to have that conversation with connecting buyers and sellers throughout the year, which provides a great data set for us, which enables us then to have this flywheel effect of producing better connections at live events. We've believed that from day one. It's quite a popular strategy right now in that people are trying to explore it and exploit it. We've been doing it from the outset, and it works. We've doubled the size of the business in the private equity hold time that we've had. We continue to grow at double-digit rates. So we've got a model that is scalable, that we can plug M&A into, plug launches into, and continue on that growth path.
Why those verticals? Was it a choice, or was it what you adopted or inherited when you joined?
Yeah, a little bit of both. When I joined the company, it wasn't really organized into those 4 verticals for various reasons, and no real commentary on that. When we got underneath the company and we saw what we had, we wanted to organize it into something that made sense for the market. I've always been a kind of an outside-in type of strategy person. So what markets are we in? What customers are we serving? And how do we organize to make sense of that so the customers can understand us better? So a little bit of, it was a match of what we had and making sense of it. And then the strategic question of, are these the right markets? Do they have the right growth perspectives? Are they tailwind markets, as the market would call them? Or should we add others? And we did a lot of research on that and decided that actually we're in 4 really strong markets. They're all growing at different rates, but they're all growing. And let's really, really double down on these and kind of fill in the value chains of those markets. I mean, when I say we're in life sciences and healthcare, there are many aspects of healthcare that we still don't play in that give us the chance to growth into that market with adjacencies. So that was a strategic decision. And we're always looking at it. We're always going through, like, is there a 5th market that we should add to those 4? Or do we still see better growth because we know the customer set better in the 4 that we're in?
Is there a vertical you just would love to be in that you're not yet?
There are various verticals that I really like. I like the kind of energy vertical a lot, but it's pretty crowded and it's pretty well served. And if I can't add anything to that, I'd rather not do it. I'd rather stick with where we're at. So yeah, there are a few verticals that we really like, but there's also got to be openings in those verticals, or we have to buy in, or we have to acquire our way in.
So you could see at some point launching a net new vertical versus buying it.
Yeah, as long as it's at scale. I don't want to launch a 200K conference.
Right. No, it's got to be a lot bigger than that. So within those 4 verticals, right? Healthcare and life sciences, tech, wellness, and then hospitality.
Yep.
Are there any like powerhouses? Like, is there like just one of those verticals that just dominates the company?
Yeah, that changes depending on the time you ask me the question. But so if you were to ask me 6 years ago, I would have said that investment in the hospitality area, and we play specifically in investment, so we're in the finance area there, was really hot. Really, really hot. People were seeing hotels as an inflation-proof medium. Today, though, I have to say the life sciences and healthcare space, that's probably been the last 2 years, has really taken off. And there's one other that has emerged, and credit to our team, I think, for this, the stream TV area, which is in the entertainment tech area of our business. that has also taken off, really up to the right in all areas. So it changes in terms of the velocity of growth. But today, life sciences, healthcare, and then I'd say the streaming TV area are both. Stream TV grew 80% last year.
Wow.
It's from a smaller base than
Sure.
life sciences, but life sciences grew 11% last year, and that's from a huge base for us, at least. It's sometimes having a portfolio can be seen as a negative because it's not as clean as being in one place. But often it also gives you that optionality of if something's having a little bit of a tougher time, but one of your portfolios is really, really going for it, then pour some gas on that one.
I mean, diversification is not a bad thing.
I don't think it is. I've never thought it is. I mean, I think you've got to be careful you're not spread a mile wide and an inch thin kind of thing, or inch deep. At the same time, I think you've got to really know your verticals. It's back to that customer sort of first approach.
We're going to talk about organizational design in a second because I actually, when you have a multi-vertical approach, like there are different ways to structure your company. But before we do, you made a comment about wellness and life sciences starting to play a little bit.
Yeah.
What does that mean?
What's starting to happen is, and you're probably seeing this certainly we're seeing it from our health insurance company. So, in the US in particular now. So, health insurance companies are basically realizing that the healthier an employer set is, the better that is for their numbers. They're not paying out insurance claims. So they're actually encouraging employers now to send their teams to the gym. They're doing webinars on nutrition. They're starting to look at sleep and are you getting enough sleep? And all of these kind of things, which actually make you a healthier human. Therefore, you put less stress on the health systems.
Right.
Then you start to get into interesting sort of technology plays like the Fitbits and the Apple Watches, who are now starting to really enter the health system. People like Amazon as well. And there's a combination of, are you looking after yourself? Plus, hey, if there's something wrong, we're going to give you an early warning system, and then we can sort of get it before it gets too serious. So that idea of looking after your health and the whole sort of longevity play that comes around it as well is starting to merge a little bit at the health insurance, health payer part of health. But we see that sort of, we see a category called well care, which is sort of in between healthcare and wellness, that is pretty interesting to explore.
So a year ago, you did an interview with Christiana, our editor, and you said that 2025 was looking like it was going to be an absolutely incredible year for you. How did the year finish for you based on your early projections and your look back on the year?
Yeah. Again, another thing I got wrong. It was a good year. It was a very good year for Questex last year, but it wasn't an incredible year. And the reason it wasn't an incredible year is that what I didn't see was Liberation Day.
Right.
And if I now look back on 2025, that second quarter was really a tough quarter. I think the sort of marketing budgets ground to a halt. CEOs said, hey, hold on a minute, what's going on here? And we're reliant on marketing budgets at the end of the day. That's what we live on. So if they get held up or stopped, particularly around an event, if it's like, look, we're not going to come to the event because we have no idea what's happening with this Liberation Day thing, I've lost that revenue for a year on that event.
Right.
Now, I can capture it back in digital, but often not at the extent of where the event was. So that Q2 really put a wrench in the works, in all honesty. It kind of stopped a really terrific trajectory, a great sort of start to the year, kind of crunched to a bit of a halt in Q2, and then Q3 started to emerge back. Q4 really strong going into this year. Best start to a year in my time at Questex. So, and I think some of that is because you had some pent up kind of Q2-ness. So yeah, it wasn't the incredible year that I this time last year thought it was going to be.
And it was, at least what we reported, was a bit of a double whammy for you guys because Liberation Day put a little hold on EasyFairs looking at you guys.
Yeah, anybody I think that was taking a look at any big acquisition, and there were a few, got caught in the oh my God moment of, is the world going to be turned upside down, and is this the time really for us to deploy investment when we don't really know where this is going to end? So yeah, I think we did have, as I said at the time, there was incoming interest for our company, more than one, and it all kind of stopped in Q2. It was just like, wow.
Yeah, for everybody.
Yeah. I mean, we were not alone,
Yeah.
and it was I mean, we often forget, I think, but in that moment when that day happened, it took a lot of kind of what is really going on here type of discussions, and that means people just kind of had to really recircle the wagons and think about what are we going to do.
What was the thesis behind a combination between EasyFairs and Questex?
You probably have to ask them that more than me.
Which I will.
My guess is that firstly, it's a US focus, and that's a company that has built a fantastic reputation in Europe. Mm-hmm. So the US would be a natural extension of that. There are two different approaches between our two companies, and we are a very content-first, complex, and year-round content company. EasyFairs is very much what I would call a sort of innovation on the model of the trade show. Really good, by the way. They do it really well. And I think there was lots of potential cross learnings there in terms of what could work that we don't know how to do, and vice versa. So, yeah, I think the thesis at the first piece was very strong geographically, which is probably very compelling, I think. And then after that, there's some business model kind of learnings, which could be pretty cool.
And so as you look to 2026, assuming we don't have any of these geopolitical headwinds, or the headwinds will always exist, but hopefully they're not big macro movements that fundamentally change perceptions on things, should 2026 be Questex's best year ever since you joined?
It will be.
And so you're pacing strong.
Double digit. It will be our best year in history. We actually are acquisitive right now. But I think more importantly, sort of it's across the board. It's not just in life sciences and healthcare. It's there. The tech business is doing well. The wellness business is doing well. And the hospitality business is doing well. They're all showing growth. Various combinations of growth, but they're all showing growth. So yeah, we really feel that the model, the playbook is there. And I heard an interesting comment last week at a conference I was at where keynote speaker was a pilot, and she said, you need to realize as business people that turbulence is the new platform, or uncertainty is the new platform, rather than seeing it as this kind of, oh, woe is us, we wish it was smoother. She said, as a pilot, you learn and you deal with turbulence, and every time you go through it, you learn something different and you build on that. And I thought that is actually the turnaround, or turn it on its face of what we need to look at as uncertainty. It's an opportunity.
I mean, so last week I interviewed the president of Morning Brew. We were colleagues when I was there, and for my first year and a half at Morning Brew, it was a great time. It was just 2021 to mid 2022. You couldn't ask for a better advertising market. Second half of 2022 into 2023, things got way tougher. With the first half, we thought we were the greatest operators on the planet. The second time, we all realized we were way in over our heads, and we had to completely reframe how we thought about things. Now, look, everyone who came out of that is a far better operator because of it. But we had 2 rounds of layoffs. We had to experience what it meant to contract a little bit before we expanded again. And now that team is, revenue has never been higher and their margins are strong. But you don't learn how to run a business really until you are dealing with the negative.
Completely agree.
So let's talk organizational design a little bit. So we've talked about the verticals, right? You've got these 4 verticals. How do you think about structuring a company with multiple verticals? Like, how is Questex structured?
Yeah, we have a very kind of, and I'd almost call it a religious approach to how to structure a multi-vertical company. And this is not the first time we've done this. I have a group that we've worked with in previous companies. So, direct answer to your question is that firstly, we believe that, and I'm sorry to be repetitive, but the market really matters. So you've got to be close to your customers. And by customers, I don't just mean advertisers, sponsors, exhibitors. I also mean readers. We have a significant multi-million-dollar revenue stream from paying attendees. So they're customers as well. So how do we organize? Sales, marketing, content, and event director, which is sort of a CEO of the event, are all in the vertical market. So each of those verticals has its sales teams, its content teams, its marketing teams, and its event director teams, who's in charge of the event. Everything else about our business is centralized in what we call the centers of excellence. You could call it shared services. And they partner with the businesses very closely. So event operations, so how you put on the event, lots of cross-learning, around the world on ideas that work in Singapore, could work in the US, may not, but they could. So let's share it quickly. All of our data sits at the center. So 6 million plus names in the database, all of the cleanliness around that, or all of the compliance issues around that, all of the delivery of how we deliver our programs to those audiences is all centralized in the data area under Rhonda's leadership on an Amida CDP platform, who we work with very, very closely. I know you do as well. Brand and experience centralized. So everything we do is about learning and adding and then pumping out to steal this idea into the markets. We don't allow the markets to do any of this kind of stuff themselves. Or you get urban sprawl is what is
Right.
the negative. We have a content best practice centralization. Now that's not content, that's in the market. But best practice is like, hey, this type of headline is really seeing great open rates on a newsletter, or this type of conference program really hit well and got great NPS scores. So sort of the sharing of best practices, if you will, around the organization. So, and tech. And is the other centralization. So our tech platform for our websites, our tech platform for our websites, actually, our content websites and our event websites are on the same tech platform because we don't want separate things going on. We want them to connect. Helps with the data capture. So that is the net of it, Jacob, is if you can't collaborate, we are a very bad company to work for. And that's not a criticism of anybody that can't collaborate, but you have to be able to collaborate because you can't get work done at Questex unless you can collaborate.
So the pros to that structure are your sales team is closer to the customer, your content teams are closer to the customer, your events people who are actually organizing those events understand what the customer is looking for. The theoretical con of that is you've got 4 marketing teams, you've got 4 sales teams, you've got 4 events teams, actually 5 because you've also got that central event team. What does that do to your margins? Do you think that has compressed your margins, or do you think it's actually not a problem because it's actually resulted in faster growth?
I actually think it hasn't compressed margin. I can say that for a fact. I'd say it's expanded margin because what you're doing is you're reducing duplication. So I'll talk about your duplication in terms of those functions in a second, but what you're not duplicating, because if you carried on and you were just organized by market, you'd have sales, marketing, content, event director, event operations, data management, digital platform manager, VP of technology. And so if you had 4 groups, you'd have 4 versions of all of the above instead of having the marketing, sales, content, event director across the 4. And by the way, what we do is we organize councils across those 4. So every marketing manager is on a marketing council across the board. Every sales leader is on a sales council across the board. Sometimes I'm in those meetings, often I'm not in those meetings, but they're sharing ideas. What's working for you? We just had this special early bird promotion. For some reason, it really worked. Okay, great. I should probably try that on my event, which is coming up in 5 weeks. So we have this kind of cross-sharing. But from a cost perspective, actually, I would say that this structure really scales well if you're growing. I thought you were going to go with the question is the real con is if you're shrinking, you've got a lot of shared services. So I've got 20% of her working on this and 50% of her working on this and 30% of her working on this. If the revenue's shrinking, I can't cut 20% of somebody. And if I cut 100% of her, then this 50% of her is left fallow. And what are we going to do about it? So it works very, very well in a growth organization. In fact, I'd say it's by far the best mechanism in a growth organization because it just scales. You get acquisitions, you plug them in, it scales. But if you're in tough times, toughest time we had was COVID, which, by the way, we did not lay off anybody and did not go down that route. Let me correct that. We laid off very few people, had a little furlough, but we were able to punch our way through it because actually we turned our entire shared services organization to a digital shared services organization because we had that ability to do so. So I actually think the cons are a little more kind of nuanced in a shared services organization. You've got to be able to work together. I mean, where often people that are running a business will say, hey, if I had my own people, I could move faster, I could do this better. Why do I have to go and now convince somebody in the center that they've got to do this? And it's why you've got to have a culture of partnership and collaboration. You can't see the center as your do it people. They're your partners and often have better ideas because they're seeing it across other areas. So why wouldn't you want to pick their brain?
Is there a way, though, with that the center of excellence of the shared services, that you think about allocation of resources? Does one vertical inherently get more just simply because of size or because of growth potential? Like, how do you think about that?
That's a kind of a yes and no. So size, yes. Growth potential is really around we're going through this right now, actually, a 3-year strategy set of work from the markets. So what is your 3-year strategy? What investment do you need? Where do you see yourself going? And then we resource plan around that. And yeah, look, if something's growing at 80%, we are often going to say, hey, we need some more resources on stream TV. And that's probably going to be at the exception of something that's growing at 2%, which, hey guys, we're going to have to really sort of tighten up a little bit here. And that's just the way it is. So yeah, you do have to have that constant sort of dynamic discussion and making it work.
So organizationally, or from a people perspective, organizationally, what challenges exist? Is it like acquiring the right talent, retaining the right talent? Like, where do you find the difficulties? Because I mean, as a CEO, that's like one of like the top 4 jobs, right? Like, talent is the core part. So what are some of the challenges you're finding?
Yeah, I think I had to zoom out from Questex a little bit here first, because I think the industry itself, the B2B marketing and events industry, we probably don't do the best job of telling the story about what we are. So if you're a college graduate and you're thinking, what am I going to do with my life? And you're already very aware of, I could get a job at TikTok or Google or the plethora of AI companies that are out there. You can say that I get. That's a up to the right IPO. I'm going to be a multimillionaire. That's attractive to me. This event thing, what is that? And B2B events, wow, that doesn't sound very exciting. So I think talent starts with how are we widening the funnel at the top, and we're doing quite a lot of work at the CISO angle, and a lot of associations actually with us to try to expose that this is a really interesting industry. You can get a lot of great experience. It's like a stem cell industry almost. You can grow into any career you want to grow into, and we've got to get that across. So yeah, talent at the top of the funnel, we have to work really, really hard at. Then there's competition for talent. I'm not the biggest company in the world, and I'm not the biggest company in our sector. So we have to really work hard about what kind of culture are we presenting. How do we, when we do hire somebody that we really like, how do we get him or her to hire 20 of their friends and introduce them? So we do a lot of things around incentives to get people to bring their friends and former colleagues, if they have some, to our company. And if I go up a level, it's really a lot of work around things like this. If people see this podcast and they go, hey, that looks like a company that I'd be interested in. I mean, you've got to do a lot of brand work. You've got to do a lot of cultural work. And it was always my goal when I came to Questex, having learned from previous companies, that I wanted to create a culture that people were very, very proud of working in. So they just went and told everybody, whether they left the company or stayed. Right. If they left, they went and said, I had a great time there. And actually, if you want to go anywhere, you should go and have a few years there. So talent is a challenge. There's no doubt about it. Finding talent, keeping talent, not once we get them. Actually, we're doing a pretty good job of that. We have very, very low attrition rates. We don't tend to lose people, at sort of 15, 20% a year or anything like that, frankly. So we're way below industry averages. So getting them, we know we can create a great environment, a great culture for them. We've just hired a head of talent and recruitment, actually, who was previously the Informer, and he's doing a great job of banging the drum out there and saying, hey, we've got to shout really loud. We're Questex. Yeah. We got to shout loud. And our advantage, we all know each other. We're small at the moment. We're growing fast, which gives you career growth and gives you opportunities to build your own strengths and skills. and we're actually good people. It's a really good place to work. We have I like to say a very low, can I say this on your podcast, asshole quotient?
It's my podcast. You can say anything you want. I just like that a 9-figure business can refer to themselves as small, which means
it's all relative. Yeah,
which means my business is at the cellular level.
I like to have that small entrepreneurial mindset because I think we have to think like that, or we're not going to win.
How do you? I've always kind of seen a difference in the interviews I do between someone who is a founder and someone who is an executive.
Yeah.
A founder doesn't give a fuck, right? We're gonna go there. They'll say anything, right? They'll share their numbers, they'll share their pains, their good, their bad, because they're not afraid of looking bad because it's their business.
Yeah.
An executive, on the other hand, tends to be pretty guarded, right? They're only going to share enough. They're not going to go too far. They're not going to the responses that they give to questions are always they're polished. You guys, none of you started Questex, but you guys don't tend to have that executive mindset. You do share more. You're pretty candid when I ask you questions. Sometimes you say no comment, but you're pretty candid. What is that about? Why do you think the team is that way? Because you all are that way.
Yeah, that's a really good question. I have to think about why is that. Firstly, it stems from a kind of a core value that I personally have, but probably more importantly, we've written down as a company value, and that is authenticity matters. Transparency and telling the truth matters. Now, I have to be honest with you, there are limits to my transparency. I can't talk everything like you say a founder would, because I have 300 people out there working remotely around the world, and I have to be cognizant of the fact that people can interpret things the wrong way. If I'm a founder, it's like people are seeing me every day and they're probably sitting next to me. So they think, did you really mean that? It's like, no, I didn't mean that. It's like, oh, okay, great. Because I interpreted that the wrong way. So you've got to be careful that you're authentic and transparent, but that you're giving people enough for them to do their jobs really, really well. So the next piece is trust. Because if you're going to be authentic and transparent, you then have to trust that people are going to take that, behave like adults, and make better decisions because they know more. And I think that where it goes a bit wrong in your example of being too corporate, I guess, is that you sometimes can believe that everybody knows what's going on because at some point it was said. Whereas I think in today's world, it's funny, Kate Spellman and I talk about this a lot. When we started in our career, the rule of 7 was in place. You had to say something 7 times before your customers really got it. Today, it's something like 18. You have to say something 18 times. And by the way, not just customers, but your employees. So you think when I've said something 9 times, I'm like, I'm bored.
Right.
But our employees are only halfway there. So that transparency and authenticity matters. The other part of it that I think is really important is that I personally don't have the capacity to act. Some people do, and they're very powerful. But what that means is they can say something as part of the act, and then 4 months later, they're on a different act. And I don't have the capacity in my brain to remember what I said in my act 4 months ago. So just tell it as it is, because that never changes. That's the truth. And I think that that helps people, whether they're in our company or not in our company, realize that you're being treated as an adult. You're being given the information to make better decisions. And if you don't have enough, come back and ask. Right. But on the whole, there's not much more I can share with you. This is it. This is how we're doing. This is the good, bad, and the ugly. And in our internal town halls, I will say, look, this is going great, but they're not rah-rah sessions. We need to do better here, and we haven't done as well as we should have done here. And I trust that people are going to treat that transparency in the right way.
All right, so let's dive into the structure of more about the type of products you're offering, what the company looks like from the customer offerings. So over the past couple of years, maybe even longer than that, you have made a shift in your go-to-market for your events. You used to have a lot of events, and now you've sort of compressed it down into fewer, bigger shows. Talk a little bit about that strategy, what went into making those changes and all of that.
Yeah, that came from two converging directions. The first and probably the most important was the customer direction. Was feedback on you've got too many events. They're not really events that we can attend 85 of them a year in one particular vertical. Frankly, the experience is a little bit kind of cheap and cheerful because when you're running small events, there's only so much you can do on the experience. And we're actually a little frustrated that you've got 4 events this quarter, all of which are relevant to me, but I can only afford to come to 2. So 2 I'm going to miss, and that's because of your structure, not because of me. Right. So that's the customer in piece. The second piece was really looking at what's happening in the event market in general. And there's a really interesting sort of, I think, set of dynamics that are really encouraging, but also you've got to take advantage of them or they're going to sort of swarm over you like a tsunami if you're not careful. We can probably chat about that in a sec. And those dynamics were really around people are realizing that events are a really great trusted medium in an AI slop environment. Mm-hmm. So, I mean, you've written a lot about, and your team's written a lot about how companies are entering the event market when probably 6-7 years ago, they wouldn't have done that. They'd have stuck to a media content type of play. And therefore, you've got an attention situation going on. How do I get attention from my customers when they're being bombarded with all of these events? And if we're part of that by bombarding them with 85 events, then it's just basically who can shout the loudest and who, at the end of the day, gets the right person at the right time. Somewhat luck. I'm not a big believer in luck as a strategy.
It's a bad strategy.
So that dynamic from the market plus the customer feedback led us to create a strategy. And this was particularly prevalent in the life sciences and healthcare area, which by itself does have a tendency to want to spin out new events because it's a very innovative market. Mm-hmm. So we basically had a strategy that had a 3-year plan around it. Year 1, we do this. Year 2, we do this. Year 3, we do this. And then COVID hit. So Rhiannon basically said, who runs that business, why don't we just do it all now when nobody's doing anything?
Right.
And so we accelerated that strategy. Came out of COVID. We took, if I get my numbers right, 85 events down to 16. And those 16 are now down to 6. We've actually made some acquisitions, so we've gone up again. But those, interestingly, those 6 events produced more revenue and profit than the 85 produced in their heyday before COVID. So the customer basically voted with their dollar and said, thank you. We support this. This is exactly what we wanted. And in many cases, those events could be 4 events under one tent, but they just are branded as one event. Fierce Farmer Week, for instance, is branded as one event, but it's really 4 events that are happening and there's commingling going on. There's a PR event and a commercialization event of drugs. Interestingly, those 2 cross over.
Right.
So people can move from one room to the other room. So it makes perfect sense. What it also does, it gives you great scale for that event. So all of a sudden now the market's going, we got to be at that event. That's the event we've got to be at. So you end up sort of cutting above the noise of all of the event launches that happen in that particular space as well. So that idea was really an outside-in kind of push that COVID probably, if it had one thing that it did for us in a positive way, is it forced us to move really fast and rip the Band-Aid off, and it paid off, really paid off.
So I think about this for the AMO Summit. It's a 250-person event right now, which is subscale from a perspective of like how big, how much more revenue can I pull out of it? Like my costs are my cost, my venue is my venue. Like there's only so much you can do at that size.
Yeah.
Versus, I scaled the thing to 1,000 people. That opens me up to a different type of experience. One of the things that worries me about scaling the AMO Summit is I don't want to lose the intimacy of the event.
Correct.
I don't want to lose, 250 people are there. You're there, Kate's there, Rhiannon's there, Lexi's there if he's not in London, right? That's 4 people from Questex, all in the C-suite. Actually, I think you might have brought a 5th or 6th person. I look at Endeavor, right? Chris comes, Amanda comes.
Yeah.
Both of those are CEOs who are there.
Yeah.
Right? You get the event too big. Do you one day go, you know what? I'm just going to send my team there. I'm not going to go myself. Chris goes, I'm not going to send my team because it's too big now. It lost that intimate feeling.
Yeah.
How do you balance that?
I think the beauty is that when I say we're an events business at our core, so we're a connections business at our core that happens to use events as one medium, There is not one flavor of event that we have. So we have, in some cases, what I would call the classic trade show first. So trade show with a content conference around it. The big part of our event business is Confex, so it's very content first, and with probably a trade show floor or some kind of exhibition area. Then we have what I'd call executive style, more intimate buyer seller, hosted buyer, whatever you want to call them, type meetings. And actually, all of those bleed into each other. We're now putting more connections and intimacy into the Confex model. Have a C-level dinner. Here's a C-level area that we're just going to program a conference track for you. So you can actually still have intimacy, but also have scale. It's. I'm not pretending it's easy, but it's possible. But there is also a place for the intimate event, for the 250 people event. And in many cases, executives really like those events more than the big, hey, everybody see me and they're all trying to tap me on the shoulder type events, whereas normally you just want to see the people you want to see. So I'm pretty agnostic on the model. Our crunching 85 events into 6 events was not about, hey, let's lose all of the thing that makes these special to people. It was actually about keeping that, but then putting them into a bigger tent. I don't know what the equivalent would be for you, but if there were, I don't know, 17 other events that were happening in the media space in some way, shape, or form, that you became part of that, but you maintain your venue, your intimacy, etc. But the others were there if your people want to go. Your attendees want to go to those as well. So I think there's a lot of kind of innovation around those models. I'm pretty agnostic, if I'm honest, and I'm really interested in even more intimacy and sort of having people, go to a place where you've got them captured. It could be I don't know, Puerto Rico or something like that, where you're capturing people. Yeah, it's similar to the Davos experience or the Idaho type experiences for media execs. So, yeah, I don't really think one takes over the other or vice versa. You've got to do the right thing for the markets that you serve.
So, what percent of Questex is your conference or your events component?
Our events component is 75% of our revenue.
Okay. So it's predominantly an events company, even though you do have the media side of things.
Predominantly events, revenue-wise, yeah, for sure.
Margin-wise, it's more...
Margin what?
We can come back to it if you want to think about it.
Yeah, actual raw dollar margin, yes, events. But we have pretty strong media margins in terms of the gross margin, contribution margin in the media area. So it's not a drag on our profitability.
So there's been this shift towards organizers referring to their events or their trade shows as festivals.
Yep.
Some of them actually are festivals. Some of them are just trade shows with some, brightly colored lipstick. Talk to me a little bit about that shift. Does Questex do a festival? How do you guys think about that? And is this a real thing?
Okay.
It's a lot there.
Yeah, a lot there. I don't think I can honestly claim that Questex does a quotes festival as I would describe a festival as somebody that does go to music festivals. There are elements of a festival which make it a festival. I'd say something like Cannes Lion is a festival in one way, shape, or form. I think so. Why has this come about? I think is probably why you're asking, and I think there's 2 reasons really. One is that there is a demographic shift going on in our world in general, and therefore there's a demographic shift going on in who is attending events. So now you've got, I think I heard this right, you've got 4 generations attending an event now. It's really interesting. Yeah, you go from the boomers to the Gen Xers to the millennials to the Gen Z, Gen Z. Now they all expect different things from quotes a live experience. Let's just go up a level. Many of them have attended a true festival. It could be a book festival, a music festival. So for them, a live event is a live event. And now I'm going to a live event on chemical ingredients. wow, this doesn't feel like a festival. This feels like something that is quite alien to me as a 32-year-old professional, who last week was probably at Coachella and this week is at a ingredients festival, whatever it might be. So they're expecting things to happen. It could be entertainment, it could be different stages, it could be curated serendipity. It could be, hey, if you're in this session, actually you should probably be in this session because there's more people like you there. So that expectation is rising and rising and rising. I think it's going to continue to rise. So that is leading, I think, event organizers to say, well, look, we need to take advantage of that kind of demographic expectational shift. What can we do? How do we innovate around the model? And I think you're absolutely right. Some are there already, a few in the B2B world.
Far fewer than think they are.
Absolutely true. Some are really trying hard to get there and have some elements of it, and will probably get closer to it than most. Some, it's pure wishful thinking. And in my opinion, you're probably wasting cycles trying to and slapping a festival name over the top of something which is really a B2B professional gathering is a waste of time. But hey, that's up to them if they want to do that. And then I think you've got some which are just not going to be able to festivalize in any way, shape, or form. I think the other pressure is that there is investment interest. So there's outside interest in the financial world of quotes in real life, as they call it. And in real life ranges from the World Cup final to your event with 250 people. Well, they're with
different.
All due respect, they're different. So
very different,
very different. So you know that's where I think things can get lost. There's no such thing as it's like somebody used to say to me, "I'm going to Africa for my vacation." I was like, "Well, actually, that's not a country.
Right?
Where are you going in Africa? Well, what type of event are you talking about, really?" And not every event can be a festival. That's just the bottom line.
Do you want any of your shows to become festivals? Like, is that something on your roadmap? Or
no, only if it makes sense to the community. And our communities where we currently sit are all about doing business first, and that's their first level of ROI. The experience is important for them, and they'll tell us that. So we are adding elements that I would say are experiential, but it really depends on your view of what's a festival.
Right.
I mean, you can call something anything you want, but for me, more experiential type content-led events that are technology-enabled, those are definitely on our roadmap. Full-on festival, I could probably see something like Stream TV getting there, maybe Fierce Farmer Week. I could see them going closer to that area. But no, I don't see that as I'd rather be looking at our business of how we're adding increasing value and ROI to our customers, because that's just going to bring back more repeat and more new customer as well.
Of all the various products you make available to sponsors and exhibitors across all your prospecti for all your shows, what is your single favorite product? The one you love the most? Even if it's not the highest margin, just the one that you love the most.
We do a lot of product.
I know you do.
A lot of product. It's like asking me to have a favorite child, Jacob.
Which you have one, I'm sure.
I love both of my daughters equally.
I didn't say you didn't love them.
They're both my favorites, in case they're listening. I think the favorite product that I have, I hope this doesn't come across as a cop-out answer, is when we combine various solutions that are on the truck to create something that's sort of quite different for a particular customer. So it could be, I want a booth at the event with an activation of I'll pick anything, a golf simulator that we're going to have a golf contest at the event for all of the folks that come. So they capture leads that we're then going to turn into an intimate CEO dinner at Top Golf or wherever it might be, that we're then going to turn into a webinar after the event to capture all the people that didn't get to our booth, et cetera, that we're then going to turn into a content marketing campaign on your newsletter that is going to introduce people to our product launch program over the year. That's when I get really excited in a customer meeting. So it's not, I don't know if it didn't really answer your question, did it? But it's when the customer understands that you can bring more to them than a single point solution. And that sounds really, really kind of mom and apple pie, but actually it doesn't happen as often as it should. Often I find that the customer will buy, or we will sell, I don't want to put it all on the customer, a booth.
Right.
Great, gone, you got your booth, great, see you next year, kind of thing. Well, hold on a minute. We're not selling a booth. You're a seller meeting buyers.
Right.
So how are we then going to help you get the right buyers to your booth? And if they don't come to your booth, how do you get them afterwards? How do we provide lookalikes to you that may not even have been at the event? We've got 6 million people in the database. They don't all attend events every year. So
most don't actually.
Most don't. So let's say there's 5.5 million, just to pick a number, who don't go to an event. Well, what are we doing to help you get in front of those 5.5 million? When you get that right, that's magic. That's really magic. And that's when I really get excited in client conversations. And what I would say, you didn't ask me, is that CMOs are now starting to look at events more and more and more and more in this quotes AI slop world. And CMOs want creativity, they want packages, they want good ROI metrics, they want great reporting. They're not going to be content with I had a 20 by 20 booth.
Right.
It's not good enough. So that's where I get most excited. I don't think there's any one element of that package that I like more than the others. I'm agnostic.
You could have just said in the puppy park. You could have just said the little place where you can pet dogs at your events.
I love puppy parks. Is that what you?
That was why I asked you the question. I was like, how does a guy not say the puppy park at his events?
I missed the cue. Puppy parks only if they provide ROI to the customer.
Correct.
Just having a puppy park, which they're cute and they're nice and they are lovely, but that's not enough in itself for me to say it's my favorite.
So I'm going to have the Paul Miller Puppy Park at the AMO Summit this year. It's just going to be.
We should talk about that.
Just you at the puppy park all day.
We should talk about that. We'll probably end up with 5 puppies at home, I think.
All right. So you have been a big proponent of the mixed model approach, right? Like, you have digital, which is 25% of the company. You've got events, which is 75% of the company. You and I have talked a lot about this, but let's just, in your own words, like, why was that so important to you from the start? Why mixed model when everyone else was just pure play events?
Yeah. And again, I'm not sure in many ways whether this is the strategy that everybody in my place would have pursued. I'll tell you why, and we can take it or leave it, whether it's a good why. It's because it's about the customer. It's actually about the customer. It's not about us. It's not about our valuation. It's not about simple is easy to explain. It's basically saying the customer, the CMO, any customer has lots of things to do, including promoting their brand, promoting their new product launches. They'll have some bet the company product launches in that. Believe it or not, they don't always coincide with the 3 days that you are putting on your event. Right. In fact, often they don't. Sometimes a customer will put a product launch around an event because it's a good sort of anchor for them. But then they'll have 5 or 6 or 7 new product launches in the year. Do we just say, okay, we were not the right people for that? Or do we say, actually, we've got a medium for you to promote that, and then let's bring it to the event next year? So it was a very customer marketing budget focused strategy. I firmly believe that it will, in the long run, be the strategy that makes the most sense because it's really about the customer. And I always think that is the best strategy at the end of the day. But it does have its challenges. It's harder. You're often calling on 2 or 3 people at a customer rather than just one. It's not quite as easy as the single 3-day sell because it's ongoing and there's ongoing reporting and there's real life metrics that are very transparent. So you're held to a higher standard, I think, by the customer if you're going to present this type of solution. But I firmly believe that it is the right customer strategy to have both. Does it have its challenges? Do sometimes when you hear about investors who think that AI is going to wipe media off the face of the planet, and you have to explain to them, no, it's not, and here's why. Sometimes I'd rather not be having those conversations, but at the end of the day, the true north is that, is this the right thing for the customer? And the answer is yes, it is.
And so do you think that the industry is going to move more aggressively?
They're already doing it. The industry is already doing it. Whether it's specialist communities from Informa, or the adding on of event extension type products at other companies, or companies like a Clarion or a Close Still who have media product already. The industry is already going in this direction. Yeah. So I think there'll be flavors of it,
Yeah.
and there will be elements of it that are kind of the same, and some will be different. AI will play a part in that as well. But yeah, I think it just makes sense. Yeah. I mean, there's nothing where you sit there and go, well, that doesn't make sense from a customer perspective.
Right. What is the impact of AI on your business when it comes to the digital revenue component?
Some of that's still to be, I think some of it's we don't know yet. As a guy that started his career in print and was asked that question in like 1997, what is the impact of the internet on the print business? We had an idea. It was completely wrong. Let me rephrase that. It was wrong in terms of scale. We didn't think it was going to take quite as much out. And then Google ended up sucking out billions of dollars from that industry, because we just didn't see that there would be a need to search all of the information on the internet. So we couldn't always see what was coming. So I think if I break it down, AI, as I've already said, provides a super tailwind to the event industry. There is no doubt about it that in an era of, do I trust this content or not? Do I trust this video or not? Do I trust what I'm seeing is true or not? In a B2B environment, trust is it. Trust is the kind of currency, and there's nothing that beats this, a face-to-face conversation. So great news. Check AI. I had somebody tell me last week in the financial community that they're seeing the event business, in real life business, as being one of the only AI-proof businesses that is left. Great news. Great news for us. Great news for event companies, et cetera, et cetera. There is a downside to it, which is expectations are going to go skyrocketing. They're going to expect digital style reporting and ROI, but okay, bring it on. I mean, I'd rather be in that position. In our digital business, the first thing that we were fearful of was the whole conversation around SEO, GEO. Is search engine traffic going to go down? We're not search engine traffic reliant for our revenue. We are very much a newsletter driven business, and we deliver into inboxes every morning, and our job is to make sure they're opened and read, and that there is corresponding marketing services around that. Come to this webinar, download this white paper, all the usual type stuff. We actually had a growth year in digital last year, and we're in another growth year of digital this year. So the early indications are that we are not as susceptible to AI as probably some areas of content-led businesses are. But I'm permanently paranoid, I think, after living through the disruption of the internet to print media. I'm looking for the patterns, and some of them are starting to emerge, of people saying, okay, we're through with AI, we're now on the downslope, everything's great. Well, yeah, that's not true. This is going to change the world as we know it. We don't always know how yet. We're very embracing of the technology as a company. We're using various AI experiments, and even in some places deeply embedded AI. We're a very early user of Gong. So I see it at the moment as a enhancer of the business. It's certainly an enhancer of the events business, there's no doubt. And on our digital business, I think we are very specialist niche community that needs niche trusted information to make its business decisions. And that's not really conducive to a AI type search, to be totally honest. I do think, though, that there are areas of the business that are going to start to see. I mean, you saw Anthropic come out with agents in terms of subscription-based businesses and how they're going to get into data and serving up data that's normally been paid for. I don't think we know yet. I think we're literally at minute one of AI. So the key is to make sure you're really trying to read the signals very fast and adapt. But I really don't think today that AI is a threat to our business.
When I've spoken with other B2B operators, the answer is pretty typical to what you just said, which is we're primarily newsletter based.
Yeah.
And so fluctuations in traffic don't really matter to our revenue.
Correct.
And it's the same thing when we were at Morning Brew. Like we didn't have Google Analytics. We didn't look at traffic numbers. Couldn't tell you what our traffic was. But then I asked the follow-up question, which is what percentage of your net new newsletter subscribers come from Google? And then you look at that number and you find out it's like 30% or 35 or 20 or 25. If that number then drops by a third or by a fifth or by a half, what does that do to the digital business, right? And so one of the things that I think about is you're not wrong having that like owned communication via newsletter is so important, but there will still be some semblance of disruption from an acquisition perspective.
Absolutely.
And as you think about that, how is your team starting to reframe their top of funnel user acquisition approaches that might have been different pre-AI?
Yeah, that's a great question. And we have a whole team that actually works. I mentioned earlier in the center of our business, which owns our data, our databases. And there's a kind of I call it a very broad strategy on audience acquisition. So you've got everything from content that our editors create, which you can gate, and therefore you get a registration, and therefore it's not the main way that you grow your database, but it's one way that you grow your database. You've then got interestingly, the customer sponsored areas of webinars, et cetera, where the customer will also promote for you and you do your own promotion. That helps. Then there's the scouring what's out there in terms of partnerships, barter arrangements, acquisition, in some cases of names that you would then do a drip feed campaign to get them onto your list. None of this, by the way, none of what I mentioned has got anything to do with AI
at all.
It's all about knowing your audience, creating the right content for your audience, and trying to convert them into your users. Our database is growing. Our database isn't static. It's gone from 3.2 million to 4 million to 5.5 to 6. I mean, I think Kate would tell you it's now like 6.3. So the database continues to grow because we have this kind of multi-faceted strategy of how do you keep adding names to your database. Now, having said that, I don't need to be 20 million names because I'm very targeted in the markets that I'm in. So we're not in a volume game. We're in a quality game of making sure we have the right people on the list. Not that reliant on Google. And I hadn't really thought about it until you said it, but not that reliant on Google. Probably in the past, to my chagrin, thinking we weren't doing enough.
Right.
And now probably we benefit from that.
Right. You scaled without it. And now if you don't have it, whereas I'm actually trying to figure out how to get into Google News just because I had nothing from Google right now.
Yeah.
Might as well get something.
Yeah. It's all relevant. There's none of it's, if you're switching off stuff because it's too hard or you don't think it's going to work, and then I'd say that's the wrong strategy.
Agreed. All right. So Questex in 24 almost had a deal get done. You guys recapped. And then basically the idea was, and this is what you said on stage, is that you're now going to be a buyer rather than sort of like doing your own process.
Yeah.
And you've made a number of deals. I think you said you've done 3 deals.
Three in the last 6 months.
In the last 6 months. 2 on the life sciences side, 2 on the real estate side, and then there's another one that I'm missing. Or is that?
No, that's it. That's
okay.
it. 2 life sciences, 1 in the real estate side.
All right. Talk about these deals. Why these deals? What do they look like? Let's kind of explore what those are.
Yeah. Firstly, in markets that we're in all cases, an extension. I won't get too esoteric on you, but in all cases, an adjacency to the markets that we're in. So if we, in the real estate or living area, as we call it, we have a pretty big product set in the hotel investment area. People that own hotels, buy hotels, sell hotels. It's a very finance area. It's an investment play. That area is actually starting to look at what looks like a hotel that we can invest in. Senior living, student housing, affordable housing, multifamily housing, all of them look like hotels from the outside. All of them have different layers of how long do you stay.
Correct.
So the market was telling us, look, you're a little narrow. We'd like you to bring this type of experience to our other areas that we invest in. So affordable housing actually was one that a sister company of our PE ownership, our portfolio company, was moving into much more of a data-driven type of strategy, and actually had some products that it was saying we don't know if they fit. So I was actually talking to the CEO of that company. I said, well, we do events. What are they? He said, well, they're in affordable housing and multifamily housing. I said, yes, please. Our customers want us to go there. And the advantage there was we had the inside track. Yeah, we knew each other. We could get it done. It's kind of funky, and when you're doing it with the same ownership, and that you have to pretend you're really not owned by the same owner, and you have to be very, very separate. So it's kind of a bit funky, but a really good deal for us. A $4.5 million event in affordable housing, which I got to attend last year, which is absolutely the creme de la creme of affordable housing, which is one of the major issues in the US right now. Is how do you make housing affordable? Doesn't matter what side of the aisle you're on, it's a big issue. Great acquisition for us. Some of the same investors that go to our hotel event now go to our affordable housing event. CBRE, JLL, all of those kind of folks go to both. So that was a great, sort of checked all of the boxes, got us into an adjacency. And frankly, we want to do more in that area, what we call now living. How people live is really interesting to us. Life sciences and healthcare, as I mentioned, has been our best performing group for the last 18 months, probably 2 years. There are a couple of areas where we had some gaps. One was in the area of clinical trials. And it's funny, I actually, on a retreat for that group, I actually asked the group, is there anything we should be buying that you're competing with that we don't know about? And one of our conference producers said, I'd love you to look at D-Farm. It's a fantastic show. And I was like, never heard of it. He said it's in the clinical trials area, so it fits the strategy. And then the team, sort of led by Rhiannon, basically started to hold hands with the owners of that business. And we got comfortable culturally with each other. And in the end, we made a bid to buy the business. And we were not the only bidders. And interestingly, the owners of that business told us one of the reasons they chose us was because of the cultural fit. So that kind of getting to know each other and having them see who we are and how we work was very important for them, because they were the founders and they wanted their baby to go to a nice home, which is very, very sort of satisfying, I think, for us as a strategy. And that is off to the races. In fact, we have one of their events happening right now in Boston, an immunology event, which is another area we were not in. So it stretches us back into the life sciences value chain. The other area where we're strong in life sciences is in how do you bring a drug to market? Lots of issues around that. But what we didn't have was the place of market research, competitive intelligence. It's a niche of a niche. And we spotted this event that actually I was at last week, which happens in New Jersey, which is around that market intelligence, market research, competitive intelligence community in life sciences. And we basically said to their owners, look, we think we're a better owner of this business. You're a data-led business. This is an event business. And they said, actually, we've been thinking the same thing. Let's lock this up and see if we can get something done. So another one that was completely off market. It wasn't any bidding war. It was just, we did a lot of the hard work. And in my opinion, they're the best acquisitions because you get to know each other without the added pressure of you're in an auction.
Right.
So you get to do a lot of the right things. So yeah, they were the three we did in a space of 3 months actually. And there's more to come.
So I asked you before about the whole recap. How does that, what is the process of a recap? Does your owner say to you, okay, Paul, you've got $75 million now to put to work? Or is it like, how do you know when you've like extinguished what they're willing to invest in net new additions? Or
I don't know.
You don't know.
I haven't reached it yet. It certainly didn't work like that, hey, we've reinvested in the business and therefore you have a pool of money to play with. That's not how it worked. I'm not sure if that's how it works elsewhere, but for us, it was more along the lines of, look, we believe in this business. We believe that if there's one lever we haven't really pulled to the extent we should have done, it's in the area of M&A, and we agreed on that. So that's our ownership and our management team were like frustrated a little bit. I think that, hey, we should have done more M&A. And therefore we set out on a let's do more. And we have a regular meeting of targets. We have a regular internal meeting of my team around, what who we're talking to, what's out there, where are we seeing stuff that's coming to market publicly. And there really isn't in our case, there really isn't, quotes, a limit. It's if we can find the right fits and we can agree on the right price, and we've got the right plan, let's go and get it done. And frankly, it's not just small bolt-ons; it can be pretty large, transformational as well. So we're actively having those discussions. That's what we're doing. So.
But a transformational one would be you getting into like energy, as an example, like a net new vertical that is
could be that, or could be something of real size, tens of millions of dollars of revenue,
right,
that catapults us into a sort of a different kind of echelon, if you will. So it's really transformational for us would be really more based on the size of the acquisition, revenue and profit than the particular market. It could be any of the markets we're in, but it's of real size, or could be a fifth, sixth vertical that brings us that size and scale.
What is more likely, you think, with your M&A strategy? A transformational revenue size, you're adding in 20% of your business, or a net new vertical?
Probably the former.
Yeah.
Probably the former. Only because A, they exist,
right,
which is important, and B, it really helps to know the market you're in.
right.
So that's why I think it's more likely. But again, if you were talking to me 2 years ago, we would have probably been a little bit more, hey, we're not going to look at any added verticals. In fact, I think we were saying that. I was certainly saying it. These are the verticals we're in. We're going to stick to it. But we've certainly widened that aperture to say, well, actually, the model is the model. Wouldn't it be great if we could find a vertical of scale to plug into this model and make that really work to the same extent that everything else has worked? So we're actually widening that aperture, and we're more interested for sure. Finding them is the tough thing.
It's difficult.
Yeah.
Where are you projecting Questex to hit revenue this year?
Over $140 million.
Wow.
Yeah.
I feel like when you and I first met a couple of years ago, you were at like 120?
95.
Well, we didn't meet that long ago. When were we at 95?
We're 95 in 23.
Oh, wow. Yeah.
A couple of years ago.
Yeah. I knew Rhiannon. I think I met you in 24.
Yeah. 24, we weren't 120. I think we went to 109-ish, 110-ish in 24, 120 plus, now 140. So it's
4.5, which comes from this real estate acquisition, some other percent that come, or
90% of our growth is organic.
Okay.
90% of the growth has been organic. The acquisitions have neatly topped that up over the last few months.
Will you be launching net new shows and or digital websites? Like, are you launching new brands from that perspective, or is most of your focus going to be on acquisitions for the foreseeable future?
No, it's both. We've got a stream TV launch in Lisbon coming up in May.
Are you going?
Yeah, I am.
It's a good excuse to go to Lisbon.
I've been invited, so I'm not forcing myself onto it. Actually, I think a really great launch for us. It'll be 7-figure launch, which is sort of it's what we're looking for now. Is can you bring in $1 million plus?
You have to at that scale.
You really do. You really do. For us to sort of give it the right attention as well. So that's in May. I actually just got off a launch meeting this morning. With the team, which I can't talk about, but we've got another launch on the books. And next week, we've got a third launch that we're looking at, which I haven't seen the business plan for yet, so I don't know. But we're actively trying to do both. Organic's really that's where we're in our sweet spot. M&A is great, but it's not always in your control who wants to sell, when they want to sell, what the timing looks like. So I'd rather focus most of our energy on what are we in control of, to be honest.
So besides you guys in the market, who do you think is absolutely crushing it right now?
I think there's different levels of crushing it. Okay, I think you've got Hive that are crushing it at one level in that they've decided that they are going to buy product that is really meaningful from the outset. That it's big, it's established. Jonathan Weiner builds great product. They invest in great experience, and I think Hive. So I think Hive is doing a crushing it type job from that angle. I have to say, I think Informa still crushes it as a big dog in the market, over 5 billion. That Middle East announcement in Dubai, the Tahaluf thing in Saudi, the continued expansion into places like Indonesia. Informa, I think, is doing really great work, and I've always got a lot of respect for them. Closer still, we mentioned earlier, but I think Gareth and the team there have done a brilliant job of really getting into the right markets, some exciting markets, and getting in at the right time and building off that. A lot of entrepreneurial stuff going on, so I think there's lots of people crushing it. They may only have one event right now, but they're doing some really cool stuff around it. So yeah, it's sort of a lot of different sort of angles of who's crushing it. It's not easy out there, it's crowded, and we're all competing for business professional attendees. And I think I'm always learning from competitors that are doing really good stuff.
So we're going into 26. You're making new launches. You're starting to do some more M&A. What comes next for Questex? Are the stars starting to align for you guys? If the time comes to sell, are you hoping it's private equity again? Do you want it to be a strategic? Just where do you see this thing going?
Yeah, great question. And look, we're 7 years into our hold, so I think that in some ways answers part of the question. Is that that's a longer hold than certainly I think any of us planned for in 2019. I will say that our private equity owners often call it 7-2 because we lost the COVID years, and it's true. It's actually true. In our case, they would have been the massive growth years, and we just had them taken away from us, certainly from an M&A perspective. My job right now, Jacob, and bit of a bland answer, I think, to your question, is to drive this growth and continue to hit double-digit growth and put ourselves in the top 10% of performance in our industry. That, I think, will attract the people that are looking for something of a certain scale, a certain size, that has got great top-line growth and with really strong profit. But for me, I'm really focused on profitable growth right now, not just profit. The top-line growth really important. We have literally zero discussion right now. And are we going to market? Are we planning to go to market? The answer is really no. If somebody came knocking on our door and said, "Hey, we're really serious," I'm sure we'd consider it. But we're having more fun scaling the company up from 100 million to 150 million, broadly speaking, over the last year and a half or so. Well, why not 250? That's kind of where my head is at right now, is what's it going to take to get us to 250. If something happens in between, then great. And if it doesn't, no problem. That's a great place to be, and it's an exciting place to be.
All right. So I want to end with the same two questions I ask every operator who comes on. The first is, so what is some advice that you'd give other operators, because you're experiencing double-digit growth? What is some advice you'd give other operators to help them kind of get over any growth humps they might have? Or maybe it is move into more digital, just blanket advice that you'd give an operator.
Blanket advice in general would be, if you're not growing, the advice would be to really get under. This is not something I'm sure an operator isn't doing, but don't hope that it's going to come back, and don't base anything on what's happened to date, because what's happened to date is almost irrelevant. And I think sometimes we can get a little bit like, oh, it's okay. This once was a $20 million brand, and it will be again if only we could. Well, there's a reason that it's now a $12 million brand and not 20 million, and that's probably that it's irrelevant. Somebody's come in and taken the growth lunch away from you, or you've lost contact with your customer. And I again, at the risk of sounding overly repetitive, I often feel that we can sometimes lose focus on what we're actually here for. And in our case, in the media and events world, in the B2B space, it's connect buyers and sellers. We're a connections business. And the best thing you can do as an operator is go and spend time with your customers, and particularly your lapsed customers. Because when you're not growing, the workload gets really heavy pretty quickly. And you can spend a lot of time in Excel spreadsheets, and you can spend a lot of time looking at what cuts you should make, and you can spend a lot of time with legal and HR making those cuts. And nothing that I just said in the last 4 sentences was anything to do with the customer. Right. So really carve out some time to go and spend time with the customer and figure out what did we not provide them that actually turned them somewhere else. Because that marketing budgets are still going up. They just follow the economy, yeah? So they're just going to go up. Right. So that would be my advice. Before you really make any big decision, get out and spend some time with the customer. The beauty of the events industry is your customers are there for you to go and talk to.
Correct.
So just go and speak to them face to face, not on the phone, not on Teams, not on Zoom. Go and visit them. I know this is an antiquated idea. Get on a plane, go and visit them in their place of work or at an event and ask them, what are we missing? What is it that we have not done that somebody else has done for you that has put you over there? Because humans like choice. Mm-hmm. And if you give them choice, they'll sometimes go for the shiny toy just to try it out, sometimes at the expense of the solid business that you've built. So yeah, get close to your customer.
How many weeks a year are you on the road?
If you count 2 days in a week, probably 40 odd weeks a year, I am on the road.
Do you have a favorite airline?
I have a frequent flyer hostage situation, which is the One World Alliance. And whether I like it or not, I like the perks.
The perks.
I like the upgrades.
All right, last question. What is something in your life, it could be work, it could be personal, that you are absolutely obsessed with right now?
Can I have two?
Sure.
I'm permanently obsessed with my football team in England, which is Peterborough United.
I don't even know what that is.
League One.
Oh, okay. That's why
near where I was born. Very passionate. Watch every game if I can. And they are forever. So there is an analogy here. They are forever the small team trying to fight its way up by being smarter. Mm-hmm. Than other teams in terms of recruitment, playing patterns, etc. 50% hit rate, I'd say. So it's an exercise in misery. So I'm obsessed with that. The other thing I'm obsessed with, and my team will kill me for saying this, is that I am an obsessive reader, and I'm an obsessive reader of physical books. I actually can't read a Kindle or anything like that. So I love the feeling of a physical book. And there's a book called, actually the original book was called The Fourth Turning. The current book is called The Fourth Turning is Here. And it's literally about how history repeats itself every 80 to 100 years. There is a plague every 80 to 100 years. There is a world war every 80 to 100 years. And by saying that, you're probably going, hold on a minute.
We're living in the particular, I haven't read it, but I've seen the synopsis.
Yeah, we're living in the fourth turning right now. And I'm obsessed by history and how it can be a predictor of the future and how people dealt with situations like that, because I think that turbulence is the new platform and we need to know how to manage through adversity as much as when it's smooth sailing.
Dig it. Well,
cool.
Paul, thank you so much for coming on the show.
You got it, Jacob. Thanks for having me.